Hello, welcome back to the channel. The Indian stock market has taken a hit and everyone's portfolio is bleeding. But what if I told you that instead of just feeling bad about the losses, we could actually use them to save money on the taxes? Yes, by selling some of our losing stocks before the financial year ends on March 31st, we can legally reduce our tax liability. And the best part, this strategy is completely legal and used by most of the top investors. Most people miss this opportunity and end up paying more taxes than they should. But you should not. Stay with me till the end and I will show you how tax loss harvesting works, the key differences between the short term and long term capital gains, and how you can use it for your advantage right now. So, why is now the best time for tax loss harvesting? The number one is the market has dipped, meaning many of our stocks might be in the red. Number two, the financial year ends on March 31st. So, this is our chance to reduce the taxable income for this year. Number three, the government allows us to offset our losses against our gains, which can lower our tax bill significantly. So, by applying this simple strategy, we can actually save thousands of rupees in taxes while also restructuring our portfolio for the future gains. Now, you must be thinking, is this even legal? That means, if tax loss harvesting is legal, or how does this work? Don't worry, I am going to break it down for you in the simplest way possible. Let's simplify tax loss harvesting with an easy example. Imagine you made a profit of 1 lakh in the last 1 year from some of your stocks this year. Okay, but now you have to pay a capital gain tax on it. However, if you also have a stock in your portfolio that is around 50,000 loss, so now you can sell that loss making stocks and then you can offset that loss with your gains. So instead of paying tax on 1 lakh, now you have to pay tax only on rupees 50,000. That's how the tax loss harvesting works. In simple words, tax loss harvesting lets you use your losses to offset your gains, so you pay the less tax. Now, the biggest question is tax loss harvesting even legal? The answer is yes. The Indian Income Tax Act allows us to offset our losses with the capital gains. But there are rules. There are two types of capital gains, that is short term capital gains and long term capital gains. Short term losses can be used to offset both short term and long term gains. But the long term losses can only offset long term gains. The key is knowing which type of loss you have and how to use it smartly. Alright, let's say you sold a stock within an year and made a short term capital gain of rupees 1 lakh. Since short term capital gains are taxed at 20%, you will have to pay 20,000 in tax. But let's say you have another stock that is have 40,000 loss and you sell it before March 31st. So now instead of paying tax on 1 lakh, you only pay tax on 60,000. That means you just saved 8,000 in taxes. This strategy is widely used by smart investors to legally reduce their tax burden. Now, let's talk about the long term capital gains. In India, LTCG above 1 lakh is taxed at 12.5%. So, if you have made 2.25 lakhs in LTCG, 1.25 lakhs is exempt, but you will have to pay 12.5% tax on the remaining 1 lakh, which means 12,500 in taxes. But what if you have a stock with 50,000 loss? If you sell it, now your taxable gain reduces to 50,000 instead of 1 lakh. That means you only have to pay 6,250 in tax instead of 12,500. See how powerful this is. You are simply selling at a loss to save on taxes and can then reinvest in better stocks. Now, you might be wondering, can I sell a stock for loss, claim the tax benefit and then buy it back immediately? If you sell a stock just to book a loss and then buy it back the next day, it may raise a red flag. But if there is a reasonable gap before rebuying, or if you invest in a similar but not identical stock, you are on a safer side. The best time for tax loss harvesting in India is right before the financial year ends. That means before March 31st. Here's why. Tax loss harvesting only works within the same financial year. If you don't book the loss before March 31st, it won't offset the year's gain. Smart investors start analyzing their portfolio in February or early March to decide which losses to book. But don't wait till the last day. The market can be volatile and you don't want to miss the deadline. Now, what if you have booked more losses than gains? Good news. You can carry forward your losses up to 8 years. But there is a catch. Short term capital losses can offset both short term and long term gains in the future years. But long term capital losses can only offset long term gains. So, even if you don't have gains this year, booking a loss can still help you in the future. Here are the final pro tips to make the most out of tax loss harvesting. Number 1, don't sell just for tax savings. Make sure the stock has poor fundamentals before exiting. Number 2, reinvest smartly. Instead of rebuying the same stock, look for better opportunities. Number 3, check transactions cost. Brokerage and STD charges can reduce your actual savings. Number 4, plan ahead. Don't wait till March 31st. Start reviewing your portfolio today itself. By using this strategy, you can legally save taxes and optimize your portfolio at the same time. Thank you for watching. Please like, subscribe and share the video if you have liked it. Thank you.